back to the channel. Today I want to talk about mortgages. It's probably something that you're all familiar with, or maybe you've worked with in your personal lives, buying a house, selling a house. But I think it's really important in today's environment. There is a ton of housing activity, from purchasing, first-time home buyers, refinancing is in a frenzy. So I just want to talk about mortgages in general. I'm actually going to do a follow-up video on refis and PMI, private mortgage insurance. So be sure to check out the channel for that in the coming days. So we all know, or most of us probably know, what the mortgage is. I just want to talk briefly about the starting point. So when you're finding lenders, guys, do your homework. Talk to 3, 4, 5 different lenders, mortgage brokers, retail banks, credit unions. They all stick within a certain window of costs and rates and stuff like that, but they really do differ, and it could make a big difference. I mean, hundreds of dollars a month for you. Maybe some have PMI, others don't. So do your homework, do your interview, and then negotiate. Before you even, negotiate on the sales price with a seller, negotiate with your lenders. Pit one rate against the other, or this term versus that term. Do the homework to get the best terms for yourself. Okay, the 30-year mortgage is the granddaddy. It's the one that we've heard of everywhere in financial media. It's the one that's quoted and talked about the most, and for good reason. I mean, it's the most widely used, most popular one. So we all kind of know what it is. It's a fixed 30-year mortgage. It's for 30 years, and it's for a fixed interest rate. The only thing that's really going to change here is if your property taxes and or your homeowner's insurance fluctuate, because those typically get taken out of your monthly mortgage as well. So that is going to be the only varying difference for your 30-year. They've got the 15-year fixed as well. Obviously, simple math tells us when you're paying off a certain balance over less period of time, your payments are going to be a lot higher. So if you've got the cash flow to do a 15-year, good for you, and really consider it, because if you've ever seen an amortization schedule on a 30-year, you get eaten alive on interest. Like, it's scary crazy. So most of us don't even see the end of those 30-year terms, but it's pretty alarming how bad interest really gets to you. So I want to throw up a quick example here. This is actually my website. I added a financial calculator section on my website, as you can see here on the top left. The first part of it goes into a goal calculator. So with a certain period of time, contributions, growth rate, what are you going to get at the end of this period of time? Following that, we flip it in reverse. So you've got a goal number in mind, how much you need to contribute per year or whatever it is to get to that goal. So now finally we get down to the mortgage part of the calculator tool. So I've got $300,000 in here. You can see the 20% comes out to a $60,000 down payment. 30 years, 3.5 interest. You can see what the monthly mortgage payment would be. Now we can just mess around here with these. It's super easy to do. Change the purchase price, change the down payment percentage and amount. We'll keep the 30-year. Now you can see. And then what if we wanted to change it to that 15-year? You can see how much the payment jumps. Now let's scroll down a little bit. We are going to look at what I mentioned earlier, the property taxes and insurance. So you can fool around with these as well, because you are going to have to pay those. So they will get factored in. And then you can see how that adjusts and changes your monthly payment. I don't have PMI in here. Like I said, it's something that not all mortgages have. So, if you wanted to add PMI, you could kind of just add it to the property taxes if you're going to, just to kind of see what your mortgage is going to be. But okay, so let's get into the different products. We're going to talk about ARMs, adjustable rate mortgages. This is something that I think is a really cool product for people to use. It's not talked about. There's not a lot of play on the financial media about these, but I think this is, for the right individual, I think this is a really great way to save yourself some money. So the adjustable rate mortgage, it comes with a fixed interest rate mortgage for a period of time, usually 5, 7, or 10 years, and then it adjusts typically every year thereafter. Now there are caps associated with the reset adjustments. You've got your initial cap, which is the maximum amount it can reset in that first adjustment period. Then assuming you adjust every year, that's the periodic cap. So every year, what is the maximum you can reset higher? And then finally, you've got a lifetime cap. So over the course of the adjustment time frame, what is the maximum interest rate you can pay total overall? Why do I mention this? Well, typically the ARM products come with lower interest rates. So you can usually get about at least 50 basis points. Sometimes it's even 100 basis points or more. So 100 basis points, for reference, is a 1%. One interesting thing I want to point out here, these are actually even better in rising rate environments. Now, you might say to me, Steve, what are you talking about? Why would I get into an adjustable rate mortgage in a rising rate environment? Well, in a rising rate environment, that's usually when the ARMs have a bigger difference between their interest rates and the 30-year. Why is that? Well, lenders want to entice you to use an ARM, or they need to compensate you for taking on the risk because rates are in a rising environment. So they're gonna give you a lower interest rate for the fixed period of time because they view that you're taking the biggest risk and burden. Again, think about it. If you've got rising income, if you know you're not going to be in the house more than 5, 6, 7 years, look at this 5 and 7 year ARM. Probably a really great way to save yourself a few $100s a month. Guys, thanks for your time. Like I said, I'm going to do a follow-up on the refi and the PMI, so stay tuned for that. As always, you can drop us an email, click the contact us link below. Also, please check out the website. I've got that financial calculator link below. I think it's, like I said, a really simple but effective way to see some of these numbers in action and how they can affect you. All right, thanks again. I appreciate it. Always stay tuned for the next one.